Welcome back to the Deep Dive. Our mission here is to distill the core conflicts facing dominant companies, and today we are really putting a fascinating one under the microscope.
We certainly are.
We're undertaking a critical adjudication of ResMed Inc., ticker RMD. Most people know them as the undisputed sovereign of sleep.
That's the label, yeah.
And this isn't just a simple review of a quarterly report. It's about figuring out if one of the market's most celebrated compounders is, maybe facing its biggest test ever.
That's the crux of it, really. For any critical investor looking at this company right now, ResMed is an investment thesis being pulled in two completely opposite directions by these titanic forces.
Okay, so let's lay those out. What's on the one side of the rope?
On one side, you have this extraordinary competitive advantage. I mean, this is a multi-year, vertically integrated digital health hegemon, and they are enjoying what you can only call a super cycle of earnings.
A super cycle driven mostly by someone else's failure.
Almost entirely. And then on the other side of the rope, you have this existential structural debate. It's fueled by a pharmacological revolution, the GLP-1 weight loss drugs, that, could threaten to erode the company's entire terminal value.
So the core mission for us today is to decide which force wins out. Because ResMed is trading at, around 26 times trailing earnings?
That's right, about 26x.
Historically, for a business of this quality, that would be seen as a steal, a real bargain.
Oh, absolutely. The stock is trading at a significant discount to its 5-year average multiple. That was much closer to 40 times earnings.
So is this discount actually warranted? Is this telling us that RMD is a classic quality trap, priced for perfection right before its margins and its long-term growth just fall off a cliff?
That's the bear case.
Is this 26x PE a temporary dislocation? An opportunity to get into a high-quality compounder while fear is, frankly, peaking?
That's the whole adjudication. We have to disentangle the temporary from the structural. It's the only way.
So what's the plan?
We need to meticulously quantify this near-term tailwind, which I've heard analysts call the Phillips dividend.
Okay.
And at the same time, we have to assess the real severity of that long-term headwind, the GLP-1 tax, so to speak.
And the decision really hinges on whether that moat, that software and the data moat they've built, is strong enough to handle both the return of their main competitor and this fundamental shift in how the disease is managed.
It's a huge ask. It's a real stress test of the business model.
All right, let's get into it. Before we even talk about this temporary competitive gift they received, let's set the stage. Let's establish the foundational bull thesis for ResMed.
Okay.
It all rests on the immense scale of the market they serve and how little of it has been penetrated. We're talking about sleep disorder breathing, or SDB, primarily obstructive sleep apnea, OSA.
Yeah.
Just how big is this global problem?
The scope is, to be honest, it's staggering, and it underpins every single long-term growth projection for the company. Based on the epidemiological studies, we are looking at nearly 1 billion people.
1 billion people worldwide.
1 billion people worldwide who suffer from mild to severe obstructive sleep apnea. And this isn't just, disruptive snoring. OSA is a chronic, multisystemic disease.
Right. It has serious downstream health effects.
Very serious. It's strongly associated with heightened risks of major cardiovascular events. We're talking resistant hypertension, atrial fibrillation, stroke. And it dramatically increases cardiovascular mortality.
So 1 billion potential patients. I mean, that number alone seems to justify a premium valuation. But the real issue for ResMed has always been actually finding those patients, right?
The gap. That's the runway.
So what does that gap, that market penetration, look like today?
It's the most important part of the long-term story. Despite how prevalent and, frankly, deadly this condition can be, somewhere between 80% and 90% of sufferers remain completely undiagnosed. Untreated.
80 to 90%. That's an incredible figure.
It is. Even in the most mature, developed healthcare economies, the penetration rates are shockingly low. You look at the United States, which is the most advanced market for this, they struggle to even hit 20% penetration.
And Europe is even further behind.
Much further. When you look across the European Union, those penetration rates lag. They're closer to 5%. So this massive untapped pool of patients, the 800 million undiagnosed, that is the fundamental premise that supports sustained profitable growth for the next decade.
The core challenge has just been getting them diagnosed.
It's always been diagnostic friction, and that's a theme we're definitely going to come back to.
So you have this enormous, visible, but largely inaccessible market. And then fate, I guess, in the form of a massive corporate blunder, just hands ResMed a multi-year head start to go and capture it.
A gift. A terrible gift, but a gift nonetheless.
We have to talk about the defining event, the catastrophic recall of Philips Respironics devices.
The word recall almost undersells the severity of what happened here. This was a catastrophic systemic quality failure that basically vaporized the competitive landscape overnight.
When did this happen?
The recall was launched in June of 2021, and it impacted millions of their flagship CPAP devices.
And what was the actual mechanical failure? What was going wrong inside the machines?
The failure was linked to the polyester-based polyurethane foam, they call it PEPUR, which was used as a sound abatement foam inside the machines.
So just to quiet it down.
Exactly. But over time, and it was made worse by heat and humidity, that foam was found to degrade. It was breaking down into these toxic black particulates, which patients were then inhaling directly.
That's horrifying.
It gets worse. It was also off-gassing volatile organic compounds, which pose potential acute and more frighteningly long-term carcinogenic risks.
Okay, so exposing your patients to potentially toxic and carcinogenic materials, that is an operational and ethical disaster. It goes way beyond a simple product malfunction.
It's the worst-case scenario for a medical device company.
So what did that mean for the regulatory response? The FDA must have come down on them like a ton of bricks.
They did. It triggered a regulatory response that has been, I think it's fair to say, historically punitive and structurally significant. The ultimate fallout came earlier this year, in 2024.
Okay.
That's when they finalized a comprehensive consent decree. This was entered with the U.S. Department of Justice and the FDA. And this decree, it essentially places Philips in a regulatory straitjacket, one that's designed for exactly this kind of systemic failure remediation.
For us as critical investors, the terms of that consent decree are everything. They literally dictate the length of ResMed's temporary monopoly. So what are the terms?
Well, the terms are all designed to fundamentally prioritize public safety and regulatory compliance over any commercial activity. Philips is explicitly prohibited from manufacturing and selling new sleep and respiratory care devices.
So their core CPAP and ventilator lines.
Their core lines, exactly. Prohibited at their key U.S. facilities in Pennsylvania and California. And that prohibition stands until they can demonstrate to the FDA's complete satisfaction that they have robust, comprehensive, and sustainable compliance with quality system regulations.
And that's not something you could just fix in a weekend.
Not at all. And what's more, they are mandated to prioritize the complete remediation, so the repair or replacement, of the millions of existing affected devices before they can even think about resuming new commercial sales.
So their entire operational focus is diverted. They have to fix the sins of the past, which prevents them from competing in the present or even the near future. How long is this exile from the market expected to last?
Based on the complexity of achieving compliance under that kind of intense regulatory spotlight, and, analysts are tracking the stipulated milestones very closely.
Of course.
The industry consensus is pretty firm on this. Philips is functionally locked out of the U.S. commercial market for new sales through the entirety of 2025.
The whole year.
And the high probability estimates extend that restriction well into 2026. This isn't a 6-month setback. This is a multi-year competitive vacuum. It's like one competitor being forced to wait at the starting line while the other gets to run the entire race.
Okay, let's quantify this. Let's talk about the RMD windfall, the Philips dividend. What was the tangible economic benefit that ResMed reaped from this competitive elimination?
The immediate impact was substantial. In the single quarter, right after the full gravity of the recall became clear, ResMed captured an estimated $60 to $70 million in incremental revenue. Just like that.
That's the immediate grab. But the bigger prize is the structural shift in market share.
Right. That's the enduring game. Pre-recall, ResMed was the leader, but they shared the market with Philips. They held around, say, 55% market share for the flow generators, the main devices.
And post-recall.
Post-recall, that share surged dramatically. Conservative analysts estimate RMD's share in key flow generator regions is now somewhere between 60% and 70%.
And some estimates are even higher.
Some sources, yeah, particularly those tracking new patient starts through the DMEs, they suggest RMD is commanding 80% or more of the market in certain highly valuable segments.
Gaining 15 to 25 points a share in a multi-billion-dollar market. It's just remarkable. But the real financial supercycle comes from the pricing power, right? The market went from a duopoly to a functional monopoly overnight.
Precisely. Think about it from the perspective of a DME, a durable medical equipment provider. They suddenly had only one reliable, compliant source for this critical, life-sustaining medical equipment.
ResMed could basically dictate terms.
They could. And they were able to eliminate the widespread rebates, the volume discounts, and all the other pricing concessions that are just standard practice in medtech.
So you have this surge in volume combined with newfound pricing power.
And that combination is the engine that has driven their gross margins up towards that recent peak of 62%. That blend of volume accretion and margin expansion, that is the very definition of a supernormal period of earnings. And it's something that, by definition, cannot be sustained once Philips eventually returns.
Okay, so that temporary windfall is huge, but as you said, it is temporary.
Yeah.
To justify a 26 times PE multiple, let alone the historical 40 times, ResMed has to have some kind of structural protection. A moat that's durable enough to survive both Philips coming back and this existential threat from GLP-1s.
Yeah, correct. The temporary boost isn't enough.
So let's dissect the anatomy of that moat. Let's start with the classic razor and blade economics.
This model is really foundational to the company's superior financial characteristics. ResMed designs their devices, the AirSense CPAP machines, that's the razor, to be a loss leader or, at best, a moderate profit generator.
Right.
These devices, they account for about 52% of total revenue, and they carry lower gross margins, typically in the 50 to 55% range. Their main function is just to place the device, get the therapy started, and lock in that patient.
Because the real game is played in the annuity stream, the recurring consumables.
Absolutely. The blade in this model consists of the masks, the tubing, the filters, all the other accessories. This is high-margin recurring revenue. It makes up about 36% of total revenue.
And the margins are much better.
Oh, much better. It operates at an estimated gross margin of 70% or more. And the health of this annuity stream is a direct indicator of patient adherence. You can see this very clearly in their recent financial data.
What are the numbers telling us?
The masks and accessories segment delivered really robust double-digit growth. It was 12% in the Americas in the first quarter of fiscal 26. This confirms that the installed base of patients is sticky, they're compliant, and they are generating those high-margin refills month after month.
That's a great model, but it still feels very hardware-centric. You've argued that what truly elevates ResMed above a standard medtech company is the digital ecosystem, the Air Solutions platform. This is the heart of the durable moat.
It is. The digital moat is ResMed's true competitive advantage because it creates these structural barriers that, frankly, product innovation alone just cannot match.
How did they build it?
ResMed was incredibly prescient. They started embedding cellular connectivity into nearly every device they sold years ago. This established an installed base of over 30 million cloud-connected devices.
And all that data feeds into?
It all feeds into an unparalleled patient management system called AirView, which currently manages 33 million patient accounts. Now, the sheer volume of that data gives them proprietary insights, but the real moat is about workflow lock-in.
Okay, let's slow down here and really explain that mechanism of lock-in. It's highly technical, very specific to the U.S. healthcare system. Our listeners need to understand exactly why a DME provider can't just easily switch away from ResMed to a competitor.
This all hinges on reimbursement. It's all about getting paid. The DMEs are the critical link in this healthcare chain.
They're the ones on the ground.
They are. They manage patient setup, they supply the devices, they handle the billing, and they manage the ongoing resupply of those high-margin masks. Their profitability is completely dependent on successful reimbursement.
And in the U.S., compliance dictates payment.
Exactly. CMS, the Centers for Medicare and Medicaid Services, mandates very strict usage standards. The patient has to use the device for at least 4 hours a night on 70% of nights over a consecutive 30-day period.
And if the DME can't prove that compliance, they don't get paid. And they could even face costly retroactive payment denials, right?
That's the huge risk. And this is where the digital moat clicks into place. ResMed's AirView system automatically, wirelessly, and seamlessly transmits that critical compliance data directly into the DME provider's billing software.
And here's the kicker.
Here's the kicker. That billing software is very often Brightree, which ResMed went out and acquired. So you have this perfect closed-loop system. The data flows directly from the ResMed device through the ResMed management platform, AirView, and straight into the ResMed-owned billing system, Brightree.
That sounds like true workflow lock-in. I mean, if you're a DME managing thousands of patients, switching to a competitor would have to be operationally disastrous.
It's operationally and financially prohibitive. I think about it. For a high-volume DME, trying to manage a bifurcated workflow using ResMed's integrated system for, say, 70% of your patients, and then manually or semi-manually extracting compliance data from a competitor's system for the other 30%.
It would be a nightmare.
It would introduce massive administrative labor and a severe risk of billing errors. The complexity and the risk of that reimbursement denial, those become switching costs that you simply cannot justify economically. ResMed isn't just providing a device, they're providing the regulatory compliance infrastructure that guarantees the DME gets paid efficiently.
This really shifts the entire strategic intent of the company, doesn't it?
All right.
They're moving from just being a device manufacturer to being the indispensable operating system for out-of-hospital care. This is their 2030 strategy.
That's the pivot.
So let's quickly recap the strategic acquisitions that really drove this vertical integration.
It was a very calculated strategy to pivot to this platform model. The first major move was acquiring Brightree back in 2016 for $800 million.
And by owning the dominant HME billing and inventory software.
They gained unparalleled visibility into and control over their entire distribution channel. They effectively put a toll booth or the DME's primary source of revenue.
And they didn't stop there.
Nope. They followed that up in 2018 with MatrixCare for $750 million. That expanded their software expertise into skilled nursing facilities and senior living.
So broadening the footprint.
Deepening their footprint across the entire post-acute care continuum, creating cross-selling opportunities. And then most recently, in 2022, they spent $1 billion on Metafox Stan.
And that was the European play.
That was effectively replicating the Brightree strategy in Germany, which is Europe's largest healthcare market. So it provided geographic diversification, but it also accelerated that global pivot to software-defined revenues.
But hold on. If this software and workflow lock-in is so powerful, so dominant, why is their main rival, Fisher & Paykel Healthcare, still spending a higher percentage of their revenue on R&D?
That's a fantastic question.
Their spend is around 11% compared to ResMed's 7%. Doesn't F&P's high investment suggest that maybe the hardware excellence, the patient interface, the product still matters more than the digital platform?
It's a crucial challenge to the thesis. It suggests that the moat isn't absolute. It tells you that F&P, who I'd call the premium niche player, believes there is still plenty of demand for a superior product experience.
Especially in the masks.
Especially in the mask category, which, as we said, drives that high-margin annuity. F&P is a formidable engineering company. They're very strong in humidification and superior mask interfaces. They compete successfully on clinical quality and patient comfort, which matters profoundly for long-term adherence.
So ResMed dominates the workflow with its software, but F&P competes on the wearable experience.
That's a perfect way to put it. F&P lacks that comprehensive software lock-in. They don't own the DME's billing infrastructure, but they are a constant threat to ResMed's high-margin consumables business. And that confirms that ResMed has to keep innovating on the hardware side, even as they're building out the platform.
Okay, so to complete this competitive picture, we have to return to the elephant that isn't in the room, Philips.
The distress challenger. The consent decree means they aren't just behind. They are structurally restricted from even competing on new sales. They're diverting all their resources, all their R&D focus toward regulatory compliance and remediation. For the foreseeable future, they are functionally locked into fixing past mistakes.
Which leaves ResMed as the default.
The default compliant choice for almost every single new patient start.
All right, now we have to pivot. We're moving from the near-term tailwind, that Philips dividend, to the long-term structural headwind. This is the one that really determines ResMed's terminal value, the revolution of GLP-1 receptor agonists.
The big one.
These drugs, like tirzepatide and semaglutide, are achieving truly transformative weight loss. For investors, this is the existential question. Is the success of these drugs a catalyst that widens ResMed's funnel, or a catastrophe that cures away half its market? Let's start with the catastrophe scenario, the bear case.
The bearish argument is it's very straightforward and very powerful. ResMed treats the symptom, GLP-1s treat the root cause.
Simple as that.
It's acknowledged that obesity is the single largest modifiable risk factor for OSA. It accounts for approximately 70% of all diagnosed cases. So when you have pharmacological agents that can reliably achieve 15% to 25% sustained body weight loss, you are directly addressing the mechanical obstruction of the airway that defines apnea.
So the market penetration gap we talked about becomes irrelevant if the disease itself can just be resolved.
Exactly. Why worry about finding new patients if your existing ones are being cured?
And the clinical data supporting this idea, this mechanism of obsolescence, is now extremely compelling. I'm thinking specifically about the results from the SURMOUNT-OSA trial, the one focused on tirzepatide.
The SURMOUNT-OSA data is its Exhibit A for the bear thesis. The trial demonstrated unequivocal results regarding efficacy. Tirzepatide significantly reduced the apnea-hypopnea index, or AHI.
Which is the count of breathing events per hour.
Right. It reduced it by a massive 63%. For a patient, that translates to a reduction of 29.3 events per hour on average. So think about it. A patient who used to choke or stop breathing 45 times an hour is now maybe doing it 15 times. That is transformative for their quality of life.
That's a truly critical data point. The one that matters for ResMed's long-term financial model is about what percentage of patients no longer needed the device at all.
And that's the knockout punch for the bear case. The trial showed that between 43% and 51% of participants met the criteria for disease resolution.
Disease resolution, what does that mean in practical terms?
In clinical terms, it means they either became asymptomatic or they transitioned into the mild asymptomatic category. This implies a functional cure for potentially half of the current or future severe OSA market. It fundamentally eliminates the necessity for lifelong CPAP therapy.
And critically, it eliminates that high-margin annuity stream that those patients represent.
It vaporizes it.
So if you model that out, what is the actual actuarial risk of this kind of structural decline?
The bearish models have quantified this risk pretty precisely. They're estimating a potential structural decline in core CPAP device volumes ranging from 10% to 23% relative to the pre-GLP-1 baseline forecasts by the year 2030.
And if your most profitable, most highly adherent, chronic severe patients are the ones transitioning out of the system.
It poses a profound risk to the stock's long-term growth multiple, which currently relies on sustained volume expansion.
Okay, that is the catastrophe scenario. It's a compelling one. Now let's pivot hard to the bull case, which of course ResMed's management has been forcefully advocating. How do they possibly turn this threat into a net positive?
Management argues that the explosive popularity and awareness around GLP-1s actually acts as a massive beneficial screening event, a catalyst that significantly widens that diagnostic funnel we talked about earlier.
Okay, what's the logic there?
The logic is that these drugs are expensive, and patients who are seeking reimbursement often have to document related comorbidities, like OSA, as part of the whole prior authorization process. This compels that massive, undiagnosed 80 to 90% population to finally engage with the diagnostic process.
So the drugs force patients into the health system, and ResMed is there to benefit from that increased patient flow. Is there any real-world data to back this up, or is it just a theory?
No, there is data, and this is where ResMed gets to leverage its massive proprietary data set. Their own real-world data analysis, which traps hundreds of thousands of patients through AirView, provides a really compelling counter-narrative.
What does it show?
The data shows that patients who have been prescribed a GLP-1 are statistically 10.7% more likely to initiate PAP therapy than a matched cohort of non-users.
Wow, okay, so it's driving diagnosis and adoption.
It is. And furthermore, once they're on the device, GLP-1 users demonstrate better overall health engagement. They show higher adherence and higher resupply rates. It's about 3% higher adherence at 1 year and 5% higher at 2 years. The drugs seem to make the patient more engaged with managing their chronic health overall.
Okay, this is the critical synthesis point for any seasoned investor. It's clearly not an either-or situation. We have clear evidence the drugs reduce the severity of the disease, but we also have clear evidence the drugs increase therapy initiation and adherence. So what's the long-term nuance here?
The nuance is everything. First, you have to remember that weight loss is not a guaranteed universal cure for OSA.
Right.
Craniofacial anatomy, airway dimensions, muscle tone, these are all factors that are independent of body mass index. Many patients who achieve significant weight loss will still remain in that mild to moderate OSA category.
And they'll still need therapy to manage residual symptoms.
Exactly. Things like chronic daytime sleepiness, which severely impacts quality of life and productivity, they'll still want treatment.
And second, there's this pivot in the narrative. Moving from we're just treating snoring to we're treating underlying cardiovascular risk factors.
Precisely. ResMed is shifting the narrative. There's emerging clinical research that strongly suggests that while GLP-1s are phenomenal for metabolic markers and weight, the mechanical therapy, the CPAP machine, provides distinct benefits for cardiovascular health.
Such as?
Such as reducing vascular inflammation, which weight loss alone may not fully achieve. This reinforces the argument for combination therapy, especially for patients who have pre-existing cardiac issues.
So the risk is less of a sudden cliff where the market just vanishes.
It's much more a long-term erosion of acuity mix. The number of highly profitable, severe patients probably shrinks over time, and RMD has to manage a larger base of lower acuity and potentially less adherent patients. It's a more complex, but maybe not catastrophic future.
All right, let's connect this back to the numbers. The company is currently surfing two massive waves. the Philips dividend, and the post-pandemic supply chain recovery. Let's look at the financial results that reflect this supernormal environment. How robust are the earnings, and are we really looking at peak margins?
The earnings quality right now is exceptional. It's being driven primarily by margin recovery and that pricing discipline we discussed. For fiscal year 2025, revenue hit $5.15 billion. That's a solid 10% year-over-year growth.
And that momentum has continued.
It has. It continued into Q1 of fiscal 26, with revenue climbing another 9% to $1.34 billion. This success is directly attributable to that volume displacement from Philips and the pricing power that ResMed has enjoyed.
Let's zero in on the margin story, because that's where the real leverage is. Supply chain costs, especially freight, were historically high. What does the margin recovery look like today?
The margin expansion has been the single largest lever driving their earnings accretion. The GAAP gross margin expanded significantly, hitting 61.5% in Q1 26. The non-GAAP figure was even a bit higher, touching 62.0%.
And that's a huge jump from the prior year.
It's a substantial 290 basis point increase year over year.
290 basis points is enormous.
Yeah.
What were the specific factors that drove that recovery?
It was really driven by two main levers. First, the normalization of global air and sea freight costs, which had been a major drag on margins.
Right.
And second, manufacturing efficiency gains. They've been scaling up production at their state-of-the-art Singapore facility, which is both geographically strategic and highly automated.
So that efficiency, combined with minimal pricing concessions,
Resulted in really strong operating leverage. You can see it clearly. 9% revenue growth translated into a much faster 19% growth in non-GAAP operating profit. That expanded their operating margin to a very healthy 36.1%.
That degree of operating leverage, coupled with the recurring revenue model, it certainly paints the picture of a financial fortress. Let's look at the balance sheet and the cash generation.
It's a phenomenal cash-generating engine. Free cash flow surged to $1.7 billion in fiscal 25. That's an increase of 28%. And the balance sheet is pristine.
They're in a net cash position, I believe.
They are. They ended fiscal 25 in a net cash position of $541 million. They had $1.2 billion in cash against only $668 million in debt. Furthermore, this is a remarkably capital-light business.
Oh, so
Capital expenditures were negligible, around $90 million, against $1.75 billion in operating cash flow. They simply don't need much capital to keep the flywheel turning, which means almost all the cash they generate is available for deployment.
Okay, so you have a market leader, dominant margins, low capital intensity, a net cash balance sheet. This looks like the quintessential high-quality compounder. But this is where we have to introduce the crucial capital allocation critique, the so-called diversification argument. Where did all that cash go, and why are critics so unhappy about it?
Well, the critics argue that management deployed this considerable capital quite poorly. They spent billions on that SaaS vertical integration strategy we talked about, Braintree, Matrix Care, and Metafox Dan.
And the pitch for those deals was?
They were pitched as high-growth, high-margin strategic pivots that would diversify the revenue base and deepen the moat. However, the recent growth figures for this segment are, to put it mildly, lackluster. They're generating disappointing returns relative to the very high acquisition prices they paid.
What are the specific performance numbers for that software division?
The residential care software division, which contains all those massive acquisitions, it grew only 5.9% in the first quarter of fiscal 26.
Only 5.9%.
Yes, and that is significantly below the 9% to 12% growth rates posted by their core hardware and consumables business. And it's certainly far below the double-digit growth rates you typically expect from an enterprise SaaS business, especially one that you acquired for a premium valuation.
And the financial consequence of this strategy, the real smoking gun, is visible on the one metric that defines capital discipline, return on invested capital, or ROIC.
Exactly. Now, to be clear, ResMed's current ROIC of 20.6% is excellent. It puts them in the top tier of medtech firms, but it is demonstrably lower than their historical highs, which used to hover around 25%. And this dilution is mathematically attributable to those capital allocation choices.
Explain that link.
When you spend billions on acquisitions, you add a huge amount of goodwill and intangible assets to the denominator of the equation, the invested capital base. If those assets, in this case the SaaS division, are only growing revenue at 5.9%, then their return on that invested capital is probably below the cost of capital.
So it acts as a drag on the overall company average.
A significant drag, The $2.5 billion they spent on those three major software acquisitions is diluting the superior returns being generated by the core CPAP business.
That speaks volumes about management alignment. If the ROIC is being diluted, what are management's incentives actually promoting? What are they getting paid to do?
This is a major red flag that any astute investor has to prioritize. Executive compensation is heavily weighted toward net sales at 50% and operating profit at 50%. The long-term incentives are tied to total shareholder return, TSR.
And what's
Crucially, their compensation structure lacks any measure of return on invested capital or capital efficiency. There's no ROIC metric.
So management is structurally incentivized to prioritize empire building. They're encouraged to do large-scale M&A that pumps up the top line, even if that M&A involves overpaying for assets that dilute shareholder returns on invested capital.
Growth is prioritized over efficiency. Precisely. They are rewarded for size and profit growth, regardless of how much capital they burn to achieve it. This incentive structure partially explains those billion-dollar acquisitions of slow-growing software assets.
And what about insider activity? What are the execs doing with their own stock?
Well, you observe the insider activity, and you see that the CEO, McFarrell, has been a consistent seller of stock near the recent highs. We saw a $1.25 million sale in December 2025, a $2 million sale in November 2025.
And these are prearranged plans.
They are via 10b5-1 plans, so it's all legal. But consistent selling at premium valuations suggests that management is capitalizing on the high prices achieved during this Philips dividend period. It doesn't exactly convey deep confidence in justifying a sustained 40x growth multiple in the years to come.
Let's bring this all together and consolidate the investment case. We have to return to the valuation paradox. ResMed is a phenomenal business model, net cash balance sheet, but it's benefiting from unsustainable competitive factors, and it's facing very real structural headwinds.
And the stock trades at approximately 25.9 times TTM price to earnings.
That 25.9x multiple is the central puzzle, isn't it?
It is. And it's a steep discount to the company's historical premium multiple, which, as we noted, was closer to 40x. So this immediately tells you that the market is sophisticated. The so-called GLP-1 discount is absolutely priced into this stock. Investors are not buying the old historical growth narrative.
So to really stress test the fragility of that 26x multiple, let's use a reverse discounted cash flow analysis. If we assume a typical medtech cost of capital, what kind of performance does the current stock price require over the next decade?
Our reverse DCF analysis suggests that the current price requires an extremely optimistic scenario to be justified.
Which is?
12% annual free cash flow growth for 10 consecutive years. And that's assuming a stable terminal growth rate thereafter.
12% a year for a decade.
Yes, and the key implication here is strategic. Achieving 12% FCF growth for a decade is an incredibly tall order for a mature medtech company that's facing both competitive reversion and a fundamental structural threat like GLP-1s. It implies RMD can afford zero operational missteps, zero major product failures, and they have to successfully integrate and accelerate the growth of their software assets just to offset the hardware deceleration.
That requirement, 12% FCF growth for 10 years, it seems highly fragile. So let's dissect the three primary risks that threaten that growth trajectory, starting with the most immediate one, the inevitable competitive reversion, the return of Philips.
Risk number one is imminent. It's forecast for 2026, and this re-entry will profoundly alter the economics of the market. During the recall, as we said, DMEs were forced to rely on a single source, which eliminated their negotiating leverage.
Once Philips is back, they'll want that leverage back.
Immediately, DMEs will rapidly seek to establish a second source relationship to regain that leverage and to ensure supply stability. Our anticipation is that RMD will structurally lose somewhere between 15% to 20% of the temporary market share that it gained during the recall.
But the share loss is only half the story. The real threat is the associated pricing risk. How will Philips actually fight to regain that lost ground?
Philips has incredibly deep relationships within integrated health networks and hospitals that ResMed, which has historically focused on the DME channel, does not fully match.
And they can leverage that.
They will leverage that through aggressive cross-category bundling. They can offer significant discounts on CPAP devices and masks if that hospital system also agrees to buy their high-margin MRI machines or their patient monitoring systems.
And ResMed, fighting to protect its volume, will have to respond.
They'll be forced to respond in kind. This means they will very likely have to reintroduce the volume discounts and the rebates that they were so happy to get rid of.
So what does that mean for that recently achieved supernormal gross margin of 62%.
It means margin compression is all but guaranteed. That pricing competition will pull ResMed's gross margins from that peak of 62% back down toward historical norms, which are likely around 57%.
And that 500 basis point contraction is a big deal.
It's a severe headwind. We estimate that margin compression alone could reduce ResMed's annual earnings per share, their EPS, by an estimated $0.60 to $0.80 per share. And remember, the current 26x multiple is based on earnings at the high watermark. Reverting to a lower earnings figure will pressure that multiple dramatically.
Okay, that's risk number one. Risk number two is the structural erosion risk, the long-term threat of widespread GLP-1 adoption.
This is the risk to their beautiful, high-margin annuity stream. It's a much slower burn, but it's potentially more insidious. As next generation, maybe oral GLP-1s become cheap, widespread, and highly adherent,
Moving beyond just weight loss.
becoming standard diabetes and cardiovascular management drugs. As that happens, they will structurally reduce the prevalence of severe OSA. The threat is not the sudden collapse of the market, but that permanent erosion of the acuity mix.
The most profitable patients will be cured.
The highly profitable, lifelong customer, the severe OSA patient, will transition to a mild patient or no patient at all. This forces RMD to rely on lower acuity patients who have lower adherence rates and thus a much lower lifetime value. It fundamentally shrinks the profitability per patient.
And finally, risk number three, regulatory volatility and perpetual reimbursement pressure.
The medtech industry is, and always will be, inherently dependent on government payers. We anticipate the likely return of CMS competitive bidding rounds in late 2025 or 2026.
And what do those do to the market?
Historically, these rounds force DMEs into aggressive bidding wars to win geographic contracts, and that dramatically pressures their margins. That margin pressure inevitably trickles up to ResMed's average selling prices, their ASPs.
Putting even more structural downward pressure on that currently inflated 62% gross margin.
Right. This risk is always present, but the confluence of the Philips reentry and the return of competitive bidding creates something of a perfect storm for margin pressure in that 2026 timeframe.
So we have this incredible tension. A cyclical high watermark for earnings and margins is colliding with three distinct structural threats: competitive, pharmacological, and regulatory, that all threaten that 12% FCF growth required to justify today's stock price.
That is the complex paradox we are adjudicating. The current price is betting very heavily on the sustained growth of that sauce division and the rapid funnel widening effect of GLP-1s fully offsetting the inevitable margin contraction from Philips' return.
So what does this all mean? How do we synthesize this verdict for the critical investor?
Look, ResMed remains an exceptional business. It possesses an undeniably wide moat powered by its software lock-in and its patient data ecosystem, and it generates phenomenal capital-light cash flow. However, we must view the current earnings profile as unsustainable and supernormal. That 6x PE valuation is only reasonable to attractive if the bullish GLP-1 funnel widening hypothesis is entirely correct, and if Philips' reentry has a negligible or at least temporary impact on their long-term gross margins.
And the downside risk seems to be weighted more toward margin and multiple contraction, not growth acceleration.
Exactly. The greatest risk here is not that ResMed goes bankrupt. It's that the PE multiple contracts dramatically. If growth decelerates even modestly and those margins revert toward that 57% norm, the market will permanently re-rate RMD from a growth stock, which historically traded at 40x PE, to a mature, high-quality medtech compounder.
Which would trade closer to?
Closer to 18x to 20x PE. And given the poor capital allocation track record and that explicit lack of ROIC metrics in executive pay, the investor has to be highly skeptical that management can actually achieve the required 12% FCF growth over the next decade.
It sounds like the analysis suggests exercising extreme caution, that perhaps ResMed should be viewed more as a tactical, high-quality cyclical holding that has peaked, rather than a core, long-term compounder, at least until we have unequivocal evidence that GLP-1s are a net positive for total market volume, not just a compliance aid for a shrinking pool of patients.
We have to be skeptical of any management narrative that suggests a drug that functionally cures half of your most profitable patients is somehow a net positive. The data is simply too new, too uncertain, to bet the multi-year thesis on it.
That has been a truly thorough dissection of an incredibly complex investment case. Before we conclude, we always like to leave our listeners with a provocative thought, something that takes the data we just covered and projects its implications far into the future.
We spent a lot of time detailing ResMed's Air Solutions ecosystem, and we noted that it owns the largest repository of objective sleep-breathing data in the entire world,
33 million patient accounts.
generating over 20 billion nights of real-world data. We also observed that this enormous proprietary data asset is currently valued at zero on the company's balance sheet. It doesn't factor into any traditional valuation models.
It's the ultimate non-capitalized asset.
So the provocative thought is this. If the GLP-1 revolution does succeed in shrinking the core physical hardware market by, say, 20% over the next decade, rendering the physical device less necessary, can ResMed successfully pivot their strategic focus?
Pivot to what?
Can they transform from a hardware-dependent medtech stock into a data tech giant? Can they leverage sophisticated AI diagnostics and population health management tools, all derived from those 33 million patient accounts? This would fundamentally offset the hardware decline with pure, high-margin data and software revenue.
It would change the entire investment profile.
It would. It would change it from cyclically challenged medical hardware to a high-growth chronic disease data platform.
The ultimate evolution from the razor and blade model to the data is the moat model. That forces us to look past the next few quarters of margin compression and consider ResMed not just through the lens of a CPAP machine, but through the lens of the future of chronic disease population management. That's all the time we have for this deep dive. Thank you for joining us.